Okay, welcome everybody. Today, what is it, May 13th? Okay, so I just have some stuff up on the board, guys. So I'd like for this class, before you watch the video, read page 9, 6 to 9, 12. Okay, read it on your own, and then maybe watch the video, because I'm going to go, with the video, I'm trying to, again, read the slides that I have over here, and then talk about it on the board. Okay, now try RQ93 and PAQ93 as well. And again, today's lecture ties into yesterday's lecture. So again, if you haven't done 9.2 yet, do 9.2 as well, because again, everything ties in. Okay. All right, so let's get going then, page 9.6. Okay. So with 9.6, or sorry, page 9.6, part 9.2, the process of credit sales transactions. Okay, so with the process of credit sales transactions, again, what's a credit sale transaction? Well, let's just go back to our basic journal entry, right? Debit AR, I don't know. I think I used $1,000 yesterday, so I'll do it again. Credit cash, or no, you're not credit cash, credit sales. But there are a number of steps that go into this journal entry. Right? So again, we're going to make this journal entry, and we'll go to our T account. AR will be debit 1,000, and sales will be credit 1,000. Okay. Now again, over time, those amounts will go up and down, depending on payment. Sales will always go up, obviously, because if we do a refund, it hits a different account, our sales refund account. Okay. So, first of all, the process of credit sales transaction involves the following. Okay, so again, it's not just debited into the system or credited into the system, entered into the system. We have to accept the customer order. Okay, we have to approve credit because that AR, we don't want to put someone on AR if they're never going to pay us. Okay, we want to. It also involves the filling and shipping sales orders. Okay, and again, we accept the customer order, we approve their credit. Now we got to fill and ship the order. Okay, well, we're never going to get paid for sure. We got to invoice the customer, okay, and then we got to record the sale. Now, all this happens very quick. Okay. So let's look at the functions and the control procedures that we will have in place, okay, for each. So first of all, with customer orders, this is the first step in the cycle, in the sales cycle. Why? Well, the customer has to tell us, yes, we want 1,000 rolls of toilet paper. Okay. All right, fine. We accept the customer order. So we would enter in the order. So what this involves is receiving the sales order, okay, and checking it for authenticity, the acceptability of terms and conditions, and the availability of the inventory. Now, again, a lot of this is already tied in, okay, but that's the first thing that we're going to want to do. We want to check, okay, so again, we need to put that sales order in place and make sure that it's authentic, okay, so there's not a duplicate order, okay. The terms and conditions of payment are acceptable. Well, that's going to tie into approving the credit if they're on credit. Now, what might have happened also is, again, this is credit sales, but you would accept an order. You should have something in the system that kicks the order out if they don't have credit. Okay, so it's going to kick it out of the AR system and say, hey, red flag, this customer only gets shipped product when they pay in advance. Okay? So you know you have a control mechanism there in place. Okay? So anyway, so we accept the customer order. Okay? Everything meets our terms and conditions. Payment within 30 days, blah, blah, blah. Okay, and the inventory is available. That's key. Now, once accepted, okay, so once we accept the order, it's then recorded on a pre-number multi-copy sales order, which shows the description of goods, the quantity ordered, and other relevant data. Okay, so we've all seen an example some way, somehow of that. Now we want, so that's the customer order. Okay. Now, automation really helps things. Now we want to look at credit approval. That's the second step of the process for credit sales transactions. Now, obviously, if it's a cash transaction, it's a lot simplified. But what's going to happen here is that if there's no credit approval, it's going to flip it to say, hey, you've got to do COD on this customer. So we need to approve credit, which is the second step of the process. Now, this should be completed before the order moves into the warehouse. So again, when we're doing our control procedures, we're going to want to make sure we have all these steps in place. Okay? So with the credit approval, okay, so in order to obtain credit, the customer completes a credit application and a credit report is obtained. Okay, yes, the company's good. We can accept their credit. So once approved by the credit manager, an appropriate credit limit is set and the customer is entered into the AR master file. Okay. So again, now everything's good. We can start accepting their sales and we know we're going to get paid within 30 days. We accept them at an initial amount. Maybe in a year's time they call and ask for a credit review. Maybe we'll increase it, maybe we won't. Okay, so all these depend on one another. So again, we need to get that credit approval, which is the second step. So for each order, the amount of the order should be compared to the customer balance and the credit limit. Okay, so you might have a credit limit, say we only carry $20,000 worth of credit for this customer. Anything more, they got to start paying COD. Okay. Now, if the order puts the customer over their limit, or if the account is overdue, okay, the order should be refused. Now, you might have some sort of override mechanism, okay? You just really got to watch for that, okay? Now, strong controls over credit approval and the extension of credit impact the allowance allocation and the evaluation of receivables, okay? Because again, like I say, everything's tied into something else. So you need to, if you're going to do credit sales, that's fine, but you got to have the right procedures in place, the right controls in place to be certain that your assertions are going to be met. Okay. Now we got to ship the order. Okay, so we got to fill and ship. So this happens once the completed copy of the approved sales order form is sent to the warehouse. Okay, so the customer puts in their order. Okay, the order then goes to the credit department. It gets approved. If it gets approved, then that goes to the warehouse or the shipping department, and they're going to fill and ship the sales invoice. So this all kind of makes sense, right? Now, we want to make sure there's segregation of duties, okay? So the responsibilities of the shipping from approving and filling orders, that prevents shipments of unauthorized shipments. Why? You don't want the same person doing accepting customer orders and approving credit and then also sending out sending out product. Why? Well, there's no controls in there. You don't like that. Okay, you want a couple people in between. Okay? Because again, they could send out unauthorized shipments. Okay? Why would anyone want to do that? Someone's working in the warehouse. They have a friend working for company XYZ. Company XYZ says, "Hey, we got no money, but if you send me out this product, I'll give you a kickback of X amount of dollars," and the company can just write it off. All these little kind of things like that. Okay, you just got to be aware of that. Now, also, the goods received from the warehouse should be checked independently, okay, to determine that the approved sales order matches the goods received from the warehouse. Okay. Now, what do they mean? So when I look at this, so the goods received from the warehouse should be checked independently to determine that the approved sales order matches the goods received from the warehouse. Like, I don't know the goods received. Who's checking the goods? The customer? That's the customer's responsibility. Okay. So what I would say is I would have a picker go and pick the order, okay, and maybe someone independently verify what they picked matches the order ticket, okay, something along those lines. Now, a pre-numbered shipping document is going to be used to authorize the release of goods from inventory and the delivery of goods to the end customer. Now, what about invoicing? Well, we better make sure that once those products leave the building, that the customer gets invoiced or invoiced at the same time. So that's the next process, okay? So the key control objectives are all goods delivered are invoiced to the customer. That's most important, okay? We don't want to issue them 2,000 rolls of toilet paper when they've only ordered 1,000. Okay? Only actual deliveries are invoiced, okay? And we want to make sure there's accuracy in the price and all other calculations. Again, when we're looking at it from the standpoint of during an audit, we're going to test. Okay, so we'll test those invoices to the master sales price or sales list. Okay, and again, we're not going to test everyone. We'll pick a couple, and maybe we're going to rely on controls. Okay, so we only have to vouch a few sales invoices. But if we're going to do more of a substantive approach, then we've got a lot of work to do. So we want to make sure that we also have a segregation of duties between the invoicing function and the shipping function. So we don't want the shipper to do invoicing. That wouldn't happen anyways, but we just want to make sure of that. Now, in small companies, all these controls are thrown out the window. Like you might have one person doing a lot. Okay? That just increases your substantive testing. You can't rely on those controls because there's not enough people to segregate those duties. So from there, we'll check the shipping document and match it against the sales order, okay, before that invoice is prepared. Now, again, if we have a good control system in place, it's going to be done automatically. So we'll have an authorized price list and the preparation of the invoice. Now, again, this is done electronically. So when you do that order, it's already going to be in the system. You just got to make sure those prices that are in the system are correct. And lastly, okay, we want to use independent invoice checks focusing on prices used and mathematical inventory. So we might have a small internal control department where they're going to say, okay, let's pull 100 invoices, okay, and let's check that sales price to the master price list. Okay. So we'll compare totals for shipping documents with the totals for the sales invoices. Again, that's going to tie into inventory, okay. We want to make sure we haven't shipped more than what's on the sales invoice or vice versa. Lastly, we're going to want to record the sale. So when we want to record the sale, the key objective is to ensure the sales invoices have been accurately recorded, and we want to make sure the sales are recorded in the proper period. Okay, like if our period or if our fiscal year is January 1st to December 31st, and we recorded June 5th rather than June 12th, not that big a deal. Okay, why? Well, it's in the same month, it's in the same year. For reporting purposes, though, we want to make sure that if we make a sale and we fulfill all the terms of the sale on, let's just say, August 28th, if we fulfill all the terms of the sale on August 28th, we want to ensure we report it on August 28th, not September 5th, not September 6th. Why? Because we want to make sure it's within that proper month. We want to make sure cutoff. Okay. Now, in this case, cutoff is going to be based on the month. Okay. So, worst case scenario in that case would be that you record the sale in the wrong month. Better you record in the wrong month than the wrong year. But again, it's still important that you record in the proper period. Now, if we were doing our testing and we noticed this was always happening, that's going to say, hey, you want to look into this area. You might not have proper cutoff, or there's cutoff weaknesses. Now, when we record sales, it involves the sales invoice being entered into the sales journal, account receivable subsidiary ledger, and the general ledger control account. Now, this is not a manual system we use anymore. Okay? So, again, I'm not sure how you're doing. And now, this is why it's good when we take this class in conjunction with your Simply Accounting and your Sage class. Why? Because when you enter an invoice into your system, okay, all this stuff is happening automatically. The sales invoices is entered into the sales journal, into the AR subledger, okay, into the general ledger control account. So it's all done automatically. Also, from an audit perspective, if you have QuickBooks, okay, or Sage, something that you buy off the shelf from the store, you know that the controls, like these steps, are going to happen. Okay? Now, it's not, if you want to override, you could override, okay? But you know a lot of these steps are already in place. Why? Because it's a packaged system. It's not custom-made. Custom-made systems where you can run into a little trouble. But that involves a massive amount of testing prior to the system being implemented. So I don't know how you've seen it in Sage, but again, when I use QuickBooks, there's a feature that says create an invoice. Okay? So I go create an invoice, put in the customer name, the services I've provided, and once I put in the services I provided, I put in the quantity, and the quantity ties into the service, okay, and that service has a rate from the master price list. So again, everything is automatically entered into all these subledgers, and then behind the scenes it makes that credit up there, debit AR credit sales. Now, other possible control activities that we might have would be to check to ensure the total of the invoices entered into the sales journal matches total sales invoice posted to the AR ledger. We want to look for sequential numbers of the invoices. If there's missing chunks, why are there missing numbers? There shouldn't be. If anything, it should just be voided. But you also want to look into those voided numbers too. Okay? Why? Because voided sales transactions could represent a possibility for fraud. Why? While the customer sends in money, you get that money. Instead of putting it into the account, you void the transaction. So think about it this way. You just went and voided the transactions. It's not going to appear in AR anymore. So no one's going to call the customer and say, hey, you're 40 days overdue, you're 100 days overdue, and they call back and say, no, I paid it. Well, if you void it from the system, no one's going to be any wiser. But, except when you come and do the audit, and you say, well, why are these missing transactions? Or why do you have all these voided invoices? So customer statements should be sent to customers on a regular basis. Okay? Contact information for an individual not involved in the execution process should be provided. Well, usually customer statements are only sent out when something's overdue. That's the way it is. Otherwise, you're going to have all these unforeseen costs. So I disagree with that, but that's from the slide. All right, so we might want to do an independent check of the AR ledger against the balance in the control account in the GL. Okay, so we'll take our AR listing compared to the amount on the GL. Just make sure they're in balance. Okay, why wouldn't they be in balance? Well, sometimes you'll make a direct entry against accounts receivable rather than the account receivable subledger, and that causes havoc. Regular performance review by sales executive, including budget comparisons. So if you're on target for $1 million in sales of this product, and you're only at 800,000 or 900,000, you're going to want to look at why. One might say, well, theft. Well, it's too easy to say theft. It could be cutoff. You could have a cutoff issue. Okay? It could be an error, or it could be legit. Okay? But you've got to dive into that. That's why, again, an eyeball test, just looking at two numbers, that can give you, that's not going to give you the answer, but it's going to lead you to the answer to say, okay, what do I need to look into? Oh, less sales. Okay, are there any voids? Cutoff. Okay, do we have an accuracy issue? What if someone went in and put a sale instead of $2,000? It should have been $200,000 or $20,000. Right? So you've got to be aware of this. Was there a massive override? Okay, so again, look into these issues. We might want to look at a control activity. So looking at it, can the computer be programmed to validate credit, check inventory levels, issue instructions to the shipping department? Usually, if you have a good system, it does this. Okay? So if you're getting low in inventory, it's going to kick up a message, hey, we're low on toothbrushes. Okay? Now, remember Target? When Target came to Canada, one of their reasons for failure, I only know this because I've read it, was because they had a very poor IT system, and they had employees always going in to override certain features, and then when it came time to order inventory, they never knew what they had in inventory. That's why shelves were always empty there, because their inventory system wasn't working properly. Okay? So it's critical that such a system has access controls, programmed application controls, and controls over data files. Why? Because you don't want everyone going in there and messing around with the system. And that will cause havoc as well. Now, we might have an access control with our system too. Okay, so this permits read-only access to transactions. Okay, and only very important people within the process will be authorized to go and manipulate various features of the system. So maybe your sales list, your sales price list. Now, other computer control examples would be, we're only going to set orders for customers in the AR master file. Okay. Only orders for goods in the product list are accepted. Okay. So we don't want to be accepting orders for products we don't carry. Why? Well, maybe we're in Canada and we don't have access to selling product that's available in the U.S. That happens. Make sure that there's that numerical continuity with our sales invoices, with our sales orders. Transaction, we want to make sure that we have a computer system that transactions are processed on a regular schedule. Duplicates are rejected. Okay? Rejection of duplicates are important in all systems. Okay? And also, any irregular or unreasonable quantities and amounts are questioned. Doesn't mean it's wrong, but an irregular or unreasonable quantity, that's when you're going to question things. You know, I think of, well, it depends what business you're in, but if you're always ordering a certain quantity, you ever see the movies when, you know, they're ordering something illegal and they always order a certain amount, all of a sudden they're going for the big score. Okay, they're ordering 10 times the quantity. Okay, I watched the movie American Made. Okay, this is what I'm thinking about. Well, when they were bringing small quantities back to the U.S., no one asked. But then they had this manual. You know, even the Colombians had this massive control feature. Said, okay, well, this is an irregular quantity. Why now all of a sudden do you want this amount? Well, they had a control mechanism in place, no different than any other business. Okay, so you really got to watch. Why all of a sudden you have this massive change? And if you're doing an audit, you do the same thing. Why do you have a massive change in accounts from one year to the next? All right, let's look at cash receipts. Cash receipts make things a little bit easier. Why? Because we're not dealing on credit. So if it's cash receipt, I mean, you record the sale, we'll accept the order, and instead of it going to AR, when they make payments, debit cash, credit sales, right? Whatever, $500. However, we do have, so when we have cash receipts, or cash sales is the best way to put it. Why would we have cash sales? I don't know. Maybe we don't, it's a one-time customer, or maybe they don't have good credit. So it involves receiving the cash, depositing the cash in the bank, and recording a receipt. However, this now has its own set of risks. Why? Well, maybe the cash paid by the customer is stolen before it's recorded. Okay. Or maybe there's an error. So, you know, think of it this way. A sale comes in and your customer says, yeah, I need part 123XYZ. Okay, it's going to be $100. You take it off the shelf. You look around, no one's there. He gives you 100. She gives you 100. You put it in your pocket. You don't enter it into the system. That's an issue. Now, if you're getting an invoice, there's usually not an issue how they can avoid the invoice later. Okay, but for over-the-counter receipts, often we're going to have a cash register or a point of sale terminal be used. Okay. Now, if I was a business owner and I was concerned about cash receipts and funny stuff happening with my cash payments, I'd say, well, we're going to use debit machine. Okay? So there's very little room for debit machine manipulation. Okay? Again, you can always go in and override the transaction or avoid the transaction, but only managers should be allowed to do any type of voids. All right, so the benefits of a over-the-counter receipt or a cash register or point-of-sale system, okay, and again, most people use point-of-sale now, would be that it provides a visual display to the customer, okay, and immediate receipt to the customer. Okay, so they can see, yeah, you swiped it through $99.95 plus your taxes. Here's the invoice. Okay? Yeah, usually they're going to want an invoice too because of warranty purposes. It also provides an internal record of the transactions. Okay? And we're going to walk these transactions inside the register, and we'll have a printed control of the day's receipts. It won't be individual. We could go into our system later, but it might say actual cash receipts might be $500. Interact might be 1,700, things like that. So it'll just help you track it. And maybe you'll be able to determine, hey, are we right or are we off there? Or is there something we should look into? So common procedures with cash receipts. We're going to have supervisory surveillance of over-the-counter sales transactions. We'll have a camera up there. Sometimes the boss might look at it. So we're going to want to do independent checks of cash on hand compared to the totals printed by the register or terminal before the cash is forwarded to the cashier's department for deposit. You see this happen at Home Depot all the time. They're always taking cash trays out. Okay? That's just an independent check. So at any time, they can go press a button. They should know how much cash is in that till. So we should have procedures in place to reconcile card sales with the cash register as part of the daily agreement process. That's fairly simplistic. Okay. So basically, we want to make sure our system says $10,000 of credit card sales, and then when we print our credit card sales off our terminal, it also matches up $10,000. Okay. So we should always have two clerks open the mail. Why? Because it eliminates the chance of one clerk putting the cash or check in her pocket or his pocket and not notifying anyone. It's harder to cover up a fraud if there's two people involved. So if checks are received, checks should be immediately stamped for deposit only, and it should state the company's name. Again, this all depends on the size of the company. Now, it says here, often a remittance advice is prepared indicating the payer and the payment details, and then it's sent to the AR department for posting to the AR subledger. Okay. This, again, we're dealing with cash receipts here. So what might happen is it might immediately go to AR, but it's cleared from AR as soon as they get the cash, and it sits in AR for maybe 10 seconds. So for a bank credit transfer, the company should have a process in place that automatically detects such transfers and updates the AR records. The process is usually eyeballing it to see what came in the prior day, or you'll get some sort of listing. Again, it depends on what type of fund transfer that you receive. Okay. Now, all cash receipts should be deposited daily. Okay. Any over-the-counter and mail receipt should be agreed to the register total and the customer list. Cash receipt details are used to prepare daily cash summary and bank deposit slips. Most people have done some sort of bank deposit transaction. Now, daily cash summaries are forwarded to the accounting department. So you just want to match your cash deposit, okay, to what was deposited in accounting. You'll send the accounting department the daily summary. Access to computer programs and accounting records should be restricted. Again, only authorized personnel. Okay, that's a good control feature. And you want to journalize cash receipts and posting of the receipts to customer accounts, and that should be segregated. Okay. Now, lastly, we're going to have some independent checks should be made. Okay, so we want to make sure that we agree the total amounts journalized and posted with the amounts recorded amounts kept by the mailroom. I don't agree with that. I don't want the mailroom touching recording any amounts. Okay? I don't even want them opening up checks. That's my opinion. The agreement of total amounts journalized and posted over the counter mail receipts with the daily cash summary and deposits subscription. Want more tie-ins, bank reconciliations. These need to be done, whether it's done on a weekly basis or monthly basis. Bank reconciliation should be done regularly and reviewed by a manager, because that's going to let us look into overrides, outstanding deposits, outstanding checks, things of that nature. Lastly, again, we make the sale, but we might have an adjustment. So sales adjustments, these involve cash discounts, sales return allowances, and bad debt determination. We have a possibility here, though. What's risky is that we might have fictitious sales adjustments being recorded to conceal misappropriation of cash. Okay? So we originally record our debit AR credit sales for $1,000. Customer comes in and pays cash or a check. So what do we do? Okay. Forget that. I'm not putting that money in the company bank account. I'm going to do this. Debit sales return or sales allowance, credit AR. So we can see what happens there right off the bat, right? Because, yeah, you recorded the sale, and now the money came in, but the clerk said, don't forget this, I'm putting it in my pocket, I can make this journal entry and it all goes away. Now, that's why you always need to be reviewing sales returns and allowances, and you don't want just anyone being able to go in and make an adjustment. Okay, so you've really got to watch that, because that's an area where fraud can take place. So if we're looking then at sales adjustment transactions, so common procedures would be requiring proper authorization of sales adjustments, including the approval of the bad debt write-off. Again, customer comes in, wants to repay their bad debt. Well, okay, fine, but you want management to be able to set everything back up. Okay? Again, you don't want anyone doing sales adjustments. Okay? That has to be approved by manager. Just think of when you go to a store and you ask for a price adjustment or a price match. It's not the person running the thing through the till, right? It's management. Management is doing that adjustment. Now, management might have, there might be limits on what they can and cannot do, but again, it still requires management approval. Now, we want to use appropriate documentation, okay? For example, approved credit memos for returned or damaged items, write-off memos, and sales adjustments, whatever. We want to have that proper authorization. Now, we want to make sure there's also segregation of duties between authorizing adjustments and handling of and recording of cash receipts. So again, this goes through, that wraps up today. Again, not that in-depth, but again, you can imagine the controls that you need to have in place for sales and AR, okay, and cash sales, depending on what type of sale you make. Okay. So again, for the questions today, I'd like us to view up here, and we will continue on tomorrow. You did.